Great. Hi, everyone. Thank you so much for coming to our panel, Institutional Quality Digital Asset Infrastructure. To get started, let's just go down the road and introduce ourselves. How did you get into crypto from TradFi, and what do you do at your respective firms? So I'll get started. My name is Vicky Huang. I am an investing correspondent at Business Insider. Christine?
Hi, I'm Christine Sandler. Up until recently, I was responsible for sales, marketing, and research at Fidelity Digital Assets. And what brought me to crypto was kind of the dysfunction of the markets back in 2017. Looked at the market and thought, these are volatile markets with a lack of diversity, and thought perhaps something that I've done in the past could potentially be influential in the space.
Hi, I'm Boris. I'm the Chief Revenue Officer of Chopra. How I got into the space, I'm basically in charge of all things sales, trading, and account management, so all things front office for the firm. How I got into the space was 2017, so I'm not one of those crypto fanatics that was in early on. I bought my first Bitcoin in 2010 situation. I was in asset management, traditional finance all the way through, and 2017 I started to get calls in, and that's how I stumbled upon it, and we wanted to solve it on the custodial level to start off with, and Chopra is doing much more nowadays, which I'm sure we're going to talk about.
Hey, and Neil Chopra, I lead solutions and advisory at Fireblocks. I've been with the company about 1.5 years now. Started my career in corporate treasury, where innovation was migrating from downloading a payments file and uploading it to a bank website to enabling FTP connections. So saw a lot of the inefficiencies in the world of traditional finance. Started my crypto journey at Ripple, where I was working with obviously a lot of payments firms and enabling digital payment solutions. Started there in 2017, then moved over to Fireblocks, where saw the opportunity across just a whole breadth of use cases, different types of assets where we can then enable financial institutions to build on top of our wallet infrastructure. So really excited to be on the panel with everyone here, and appreciate everyone joining for today.
I'm John D'Agostino. I do strategy for Coinbase Institutional. I was the former head of strategy for the New York Mercantile Exchange, and we were there when we transitioned from that crazy wild floor you might have seen in the movie Trading Places to straight through processing. So I've always been kind of interested in exchange innovation. Got into crypto about 6 years ago. I teach a class at MIT, and I wrote a pretty dismissive paper of the DAO hack and the governance models that were being used to govern DAOs. That paper caught the attention of some really wonderful people, including Polychain. They asked me to be on their board of directors, and that sort of propelled me into the industry and joined Coinbase about 1 year ago.
Great. So to get this panel started, I think it's important for us to maybe define what is an institution that's participating in the space. We have this drumbeat of news about just the tidal wave of institutions going to crypto, but at the same time, I think there are also narratives out there saying there's not really that much institutional adoption in crypto. So from your perspective, where are you seeing institutional adoption in crypto, and is there really institutional adoption at all? Maybe we can start with you, John.
Sure. So obviously the first question is, how do you define institutional? And everybody probably has their own way. I think about it fairly simply as fiduciary versus non-fiduciary. So non-fiduciary individuals managing their own assets, pools of capital where there's not any outside investors, particularly retail investors, are embracing it very aggressively. Their job is to source alpha. So if you're a hedge fund and you're trailing the S&P for the last 7 years, you got to figure out something. And you're looking at idiosyncratic asset classes. If you're a family office, if you're a high net worth investor, if you're in a pooled vehicle where you don't have fiduciary responsibilities, that is your job to look at these asset classes. So that wave that you hear spoken about, I think, refers to that pool. For the fiduciary pool, it's much slower. And I don't necessarily think it's slower because anything endemic to the asset class, that's how they are structured. If you walk into a pension fund and you make an argument that they should invest in anything because it's A, uncorrelated to broader equity and debt markets, and B, has the potential to go up a lot, they'll smile at you and then think you're stupid when you leave the room, because they've heard that story before, and correlations are negative until they're not. And there's lots of things they can invest in that can go up a lot. So they don't need that sales pitch. If they don't believe it can be a core position and the market infrastructure is in place, they will wait out that asset class. I saw it in commodity futures 15 years ago, and that's what we're seeing now. So it will take time, but the infrastructure is building, and that trickle will come in. The good news is it's such a large asset pool that even a trickle is extremely meaningful.
Yeah, and I think to maybe expand on that as well, looking at sort of the industry in general, I like to delineate the technology, which is blockchain, and then the asset class, which is crypto. And I think there's a lot of the traditional space that sees the value in digital asset wallets, blockchain infrastructure, and taking traditional assets and managing them on chain, but may not have the compliance, the regulatory, and risk appetite to be able to dive into Bitcoin, ETH, and others, but being able to take traditional assets, manage them on chain, be able to open up a whole new world of liquidity and access to markets which have traditionally been very difficult for majority of investors, I think is a really exciting opportunity. And that's where, in terms of Fireblocks, we're seeing a lot of appetite and interest is this concept of tokenization. And that's where we have these tens of thousands of tokens now, but what is the utility with them? What are they going to be used for in the real world? And I think that's where we're going to start to see the cream rise to the crop in terms of which asset classes, which assets, which protocols are actually going to be leveraged now and going forward in the future.
Yes, and there is more to it, because like the tidal wave of institutions that we're all craving to come in, apart from like what John said and also agreeing with what you're saying, is highly dependent on the pure infrastructure layer that is in place. And that has still a lot of work to be done. I mean, if you're dealing with BlackRock, Millennium Capital, Schoenfeld, whoever it is, you will find yourself in a lot of meetings with compliance, and a lot of meetings with middle and back office. And those guys have very, very specific questions. First and foremost, if you are rocking up and say, well, we would run this strategy, and this is how much the strategy is spitting out, everybody is ready to crack the champagne corks. But if you then go to compliance and you have to explain that you have to open an account on an exchange somewhere that is maybe not regulated, and you need to pre-fund those venues, the conversation normally stops quite quickly. So apart from that, that you need to overcome first is that's your first challenge, and that's only what infrastructure can solve. Never mind DeFi and all that other beautiful stuff that you guys are surely interested in. But that is one of the core things that need to be fixed. And for example, at Chopra, what we've done is quite well over the course of the last 5 years is build that bridge between the tech knowledge and the finance knowledge, which is not something that is necessarily given in this industry, because most of the industry is built by tech people, and tech people have a hard time understanding finance and vice versa. So bridging that gap is a major task. And solutions like Clearloop, where you don't have to pre-fund exchanges and you can hold it at third-party custody and just ping tradable balances to the venue without actually having to do anything on chain and just settle post-trade, is basically models that we take from the traditional world in terms of DTCC, Euroclear, and try to translate that into this new world that will ultimately dominate. But like I said, it needs to be an infrastructural play first.
I don't disagree with all of my panelists, but I think there's also something that's missing as well as institutions are coming into the space. So there is a steady stream of interest, but there's also a lot of inconsistency in terms of the knowledge of the ecosystem. There are still people that are confusing, as Neil pointed out, crypto and blockchain, as well as the diversity of the assets, and then the weak, really weak regulatory construct. So the expectations are that they would like to trade or interact with digital assets in the same manner that they access other assets. But there's a lack of connectivity and access from an infrastructure standpoint. So very few connectivity options with traditional user interfaces, and then there's a missing practice management piece. So Boris alluded to the fact that once you get into a conversation with a large institution, or even a medium-sized institution, you are interacting with a broad group of folks that are not necessarily practitioners, but that have a diverse set of questions, and you're managing that as well. So the educational piece is really a pretty strong core value proposition for any infrastructure providers. It's not just the tech, it's also the educational piece.
So for the institutions who are able to, cross all these hurdles and actually have a crypto strategy or roadmap, where are you seeing the most sort of interest in terms of use cases? We have all these different business models represented on the panel from Fidelity, Chopra, Fireblocks, and Coinbase. Are they buying Bitcoin for the first time? Are they doing staking? Are they going to institutional DeFi? Where are you seeing the most interest today?
Well, we need to define of who we're talking about, because
Exactly.
it's like our client base. It's about 500 plus institute. We don't touch retail, and about 75% of them are hedge funds, trading firms, prop shops, market makers. But they are more crypto native than anything. So they've been in the game for like 3, 4, 5, 6 years, and they just need infrastructure in order to do their daily operation. Then you have exchanges, then you have platforms, neobanks that need proxy wallet solutions and treasury management. So when we talk about institutions as such, I suspect when you, for example, speak about Millennium or BlackRock, their use of BlackRock less so, but Millennium, Schoenfeld, and all the others. The interesting bit is to get the sign-off internally to actually buy digital assets to start off with, and then they are going to be very, very happy if they just simply stake it and get 6 to 8% per year, which potentially is outperforming their other portfolios quite straightforward if the market is a little bit shaky like it was last year. So stuff like this that's what I see the first use case being. I don't think that we will see the institutions coming coming back to those names and start doing scalping strategies and complex arbitrage strategies across various venues. It's going to be dipping toes and then taking it from there. That's the way that I see it.
Yeah, and I think over the past 4 to 5 years, I see this sort of fintech revolution, and when we talk about institutional money and high net worth individuals, I think a lot of these fintechs have now developed products and services that are taking away the share of wallet from what we call traditional financial institutions. And I think that's going to continue to accelerate. And so when we look at what we've sort of built as an ecosystem and a network at Fireblocks, it really started as the core sort of sell side of the crypto ecosystem, the exchanges, the market makers, and the brokers. And now it's really evolved to saying, okay, well, we've got the neobanks, the fintechs who are really stepping in and filling the void where traditional institutions are failing retail investors and customers. And so that's where we're seeing, I think, a lot of adoption around just enabling trading services, getting access to DeFi and yield products. We then see this whole NFT and Web3 space where we're very focused on enabling sort of this next generation of the evolution of where this market is going. And I think the really exciting part that I'm seeing within the customer base is the fintechs are now pushing these traditional financial institutions, and so we do have the likes of Bank of New York as an example, who is going to be offering up institutional Bitcoin custody, Cross River Bank, which is a fintech forward banking partner of ours who really focuses on banking as a service for these fintechs to provide that back-end infrastructure, is now expanding that to be able to offer crypto services to those fintechs. And so I think we're slowly starting to see this, but I do really think that in the market we're seeing this shift again over to more fintech-focused consumers because of the ability that they can move and the pace at which they can move to actually enable these services that they want and need today.
Yeah, I mean, I'll speak to, so I spent a lot of time speaking to very, very large pools of fiduciary capital, so very, very large pensions, sovereigns, et cetera. I think the narrative was, oh, when they come in, they'll dip their toe, and they'll come in, they'll take a smart beta or straight beta exposure to Bitcoin or something. And I didn't believe that, and I think it's borne out to be true, which is, again, it goes back to if they're going to take a position, they have to envision it being a core position. So imagine you're a PM at one of these large institutions, you're in your investment management meeting, you've got 15 minutes to pitch your grand idea. If the capacity limit of your pitch or the strategy limit of your pitch is beta or smart beta and up to a couple $100 million before you run into problems, you're just laughed out of the room, right, if you're sitting on a $100 billion pool of capital. So unsurprisingly, they came in hot. They allowed that individual to go and do the research and come in with a broad-based strategy. So they're coming in on equities, they're coming in at every level of the cap structure, they're doing yield, they're doing lending. Now they may be dipping their toe individually into these sectors to learn more about it and prove out the risk model, but they really are taking a broad-based approach, which again, they have to justify that as a, call it 2.5% to 4% potential position in the portfolio.
And I would be supportive of Neil's comments as well. What Fidelity is seeing is some significant interest in intermediaries that are serving retail investors where they feel they can incorporate crypto positions into broader portfolios, and they're looking to establish and create an infrastructure that would support that so that they could begin to win balances back from more fintech providers and also provide the client with kind of a more comprehensive view of a portfolio. So that definitely is a trend where we do see continued adoption from intermediaries that are serving large groups of either family office money or pools of capital in that respect, as well as continued adoption on the family office side as well. So the closer you are to that end consumer, that is definitely a trend that Fidelity is seeing. But bear in mind, the traditional side is going to come to a Fidelity as opposed to perhaps an unknown fintech company.
The one thing I'll add is that they're all really interested in asset fragmentation and tokenization of real assets, because why not? You've got these things locked up and you think you're going to magically create liquidity because you decrease the friction associated with the buy and sell. The problem with that is that doesn't just magically create liquidity. It unlocks latent liquidity. If there's interest, decreasing the friction works. But if no, like my 4-year-old daughter draws amazing photos, pictures that I love, but they're awful. And if I just decrease the friction associated with buying them, you're not going to want to suddenly create a market for them. So good assets will be successful in fragmentation and tokenization. Bad assets will stay bad assets, and there'll be no developing market. But of course, everybody's super interested in that. You will?
I'll buy it.
Done.
Yeah.
Okay.
That's a great example, John.
Yep.
How much?
I think speaking of that, can you paint a picture for us? When an institution agrees to be onboarded, when you reach an agreement, what do they want from you? I know that you have Chopra has the agreement with State Street, and then Fireblocks recently added supports Terra-based assets. Can you paint a picture for us how that works?
So, so the State Street. So what we were talking about before is like maybe very much buy-side centric. Like the sell side plays a massive role in traditional finance, which is simply in terms of reach and distribution, it's unmatched. Let's put it that way. That includes retail. What the journey looks like is that basically the question. Mm-hmm. All right. So first and foremost, you have conversations, high-level conversations with senior executives that get very excited about the tokenization bit, and then subsequently need to figure out what blockchain actually means. So you then have to go through a big cycle of educational pieces that you need to do in order to make sure that you get all the right people in the room. And at that point, what you do is you speak to middle and back office, and that is the big one that you need to drag over the line. What that means is, from a compliance, from a risk, from a operation standpoint, those are the ones that are actually calling the shots, because for a bank like State Street, this is systemically huge, which I have to commend them for, to the extent that they have been moving from run all the way down, moving extremely fast, to get this over the line, because they have massive demand on the other side. So what you need to do is have a structure in place that actually shows them that it's very much mirrored to a lot of things that they do and ease them into the stuff that is new, which is, like we said earlier, a massive educational push in order to kind of, that nobody runs around like headless chickens being all scared. It's a very, very careful approach and extremely detail driven. And it has to be because, I mean, if you look at State Street and peers, those are the most highly regulated institutions in the world. And everything is being looked upon very, very carefully. So, yeah. At the same time, of course, this is a massive stamp for the space as a whole, because those guys might be or start offering, Bitcoin, Ethereum, and 8 other currencies to start off with, all pending regulatory approval. But the big piece for them is the tokenization piece, where you can take your liquid assets off balance sheet and suddenly your whole capital requirement structure on the regulatory side looks different. So that's the interesting part, and those institutions have to be commended as well as Boni of taking those steps, because they know and see that this is coming. You can't stop that. So, yeah.
Yeah, and I live and breathe this every day. It's what my team's focused on is this educational aspect, and it's really kind of taking a step back and saying there's this whole world of crypto and blockchain, but who are you as a financial institution? What are the core markets that you're focused on, and what are you looking to enable? So it's a very use case driven discussion to figure out what makes sense for that institution, and then beyond that, what are they looking to deliver to their customers? What are those products and services that are compelling to the bank to be able to deliver and provide to their end users? And when you start there and you can actually craft that business case, that ROI model that makes sense for the bank, then it's going in and engaging with the risk, the technology, the operations folks, so that they understand how this all comes together. And what we really focus on is looking at that end-to-end flow to say, how do you engage with your customer today? What is that online banking platform or app that you're using? How can you create a digital asset or a crypto product and service within that? And then how does that then feed into your operations, your core system, and then on the back end being able to integrate into the Fireblocks wallet infrastructure, tap into the network and ecosystem, and not just saying what's our use case on day one that we're looking to enable, but how do we build out a strategy and roadmap to get from day one long Bitcoin or offer up a Bitcoin buy, sell, hold offering to evolving into yield generation products, potentially a permissioned DeFi pool as an example, then expanding into these tokenization use cases. And a lot of them can be done in parallel, to be honest, but it is a lot for these institutions to chew on. So it's let's not boil the ocean on day one, but let's think about a strategy and a roadmap that makes sense, that you're actually providing value to the bank and to your end users as well.
Yep. What about you, Christine? I know that Fidelity has been around since a long time when it comes to the digital asset arm. I'm curious to get your perspective on this.
Look, I think I agree with everything that my co-panelists have said. I also think that it's not just presenting the strategy or articulating the value proposition. It's also about kind of the documentation of the operational rigor on your side. So the role of audit and documentation is really non-trivial. When you're selling into traditional providers, that's table stakes. And so, quite frankly, that ends up being a potential opportunity for someone that is very focused on process, project management, and that rigor to really differentiate in this space as well.
I want to dive a little bit into tokenization as well. Why is this such a big deal for institutions? What are the potential advantages and disadvantages?
They have stuff they want to sell and they can't sell it. And so there's a belief that if you decrease it. So why do grocery stores place candy at about 3-foot level right before you check out? So your kids will start screaming, and that creates friction, and you'll want to decrease the friction by buying that product. So it's the same fundamental principle. So the belief is if you decrease the friction associated with a transaction, well, every time there's a new advantage in wearable technology, payment technology, what two stocks do well? Visa and MasterCard. Because again, we believe if we decrease the friction associated with a purchase, we'll do more of it. So the thesis is fairly straightforward. There are capital advantages to having a QSIP assigned to something, especially for property and casualty insurance. So it's this sort of manna from heaven if you've got these locked-in assets that you believe have more value broken up, and you can sell these things to 1 billion people on their phones versus when we did it at NYMEX, I maybe had 85,000 traders to push new products we created to on Bloomberg screens, if I was lucky. I would love to go back in time, and I built products at NYMEX that failed miserably because I had a small sample set that I believe if I had a larger one would have succeeded. Probably wrong, but that's my story, I'm sticking to it. So why wouldn't you be a huge fan of that if that's where your assets lie?
Yeah. Sorry, just to add in there as well, like I look at something as simple as a stable coin, that is tokenized fiat. And so you can, on a day-to-day basis, see the value that blockchain brings to the traditional space. And so from a Fireblocks perspective, we actually have about 40% of our customers paying invoices to us in stablecoin. We're working with the largest payment processors globally who have crypto native merchants who don't want to wait a few days to receive a US dollar international wire. So if I've got the wallet infrastructure in place as a crypto native merchant, why wouldn't I just be able to process that payment directly to your wallet using a stablecoin? The concept of merchant acceptance around payment for goods and services is just simple examples of tokenizing something as easy as a US dollar and saying, here's how we can now move and transfer value seamlessly, efficiently, in real time with little to no cost. And I just have this sort of open up a whole bunch of access and liquidity to, again, users that haven't actually seen that value previously.
This is where we are different because we are very much focused on the liquidity piece. And what I mean there is why tokenization is interesting is the infrastructure that needs to support all this from a settlement perspective, from a access perspective, and how you do this. Like sending stuff from A to B is relatively straightforward on the blockchain, right? So that's straightforward and it's faster than sending fiat via SWIFT. I agree. But it now comes to the point of like, okay, if I have tokenized Apple shares and I want to trade them against a tokenized mortgage bond, which by the way currently is not possible, you then need to figure out a way of like, where can I do this? How can I do this? Is it count, like never mind going into DeFi where it's like, because it was mentioned a couple of times, permission DeFi where you know who your counterparts are. Because without that, when we talk about tokenization, especially securities, this will not happen without regulation. So if this is regulated, it will look and smell and feel like everything else that we currently see in the traditional world. And that part needs to be figured out infrastructurally. And this is where we focus on. So it's not so much the payment flow, it's more liquidity access and post-trades solutions.
I would say it's hardening proof of concepts. So proof of concepts are being implemented now. It is really about creating a stronger infrastructure to support those proof of concepts on a more institutional basis. But yeah, it's going to take time.
So I think maybe a good question to end this discussion with is the topic of decentralization. As we see, the institutionalization of crypto makes it so that a lot of the activities in crypto on the institutional level seem like TradFi. So I wanted to get your thoughts on this, John, maybe to start with you. You are the subject of 2 books about your efforts in building out exchange infrastructure. How do you balance this crypto ethos of decentralization with the institutional level of crypto increasingly looking like TradFi?
I mean, I guess radical concept, you listen to what the customer wants. I understand the vision of this utopian decentralized future. I get it. I see it. We've had some problems with DAOs and the overly simplistic governance structures that have accompanied them, and that's created some issues. But I believe in that vision. I get it. But from an institutional perspective, the clients want structure. And liquidity hates monopolies, it enjoys oligopolies. You don't want, as a trader, you don't want all of your flow in one place. You want it split across multiple venues, but you also don't want it too fragmented. So I struggle to see a world in the short-term future where institutional traders embrace pure decentralization because there's tremendous value of centralization that needs to be replicated effectively, safely, and securely. If and when we solve that problem, then absolutely, we'll move to a decentralized world. But I don't like looking at more than 7 years because then you're a futurist and they annoy me. So in the next 7 years, that's what I see.
Yeah, and I mean, this concept of decentralization, I think we need to take a step back and say, what is it really? I feel like the people at this conference represent 1% of the entire population. If you go out into the real world.
Represents 1% of the conference, actually.
Yeah, exactly. But if you go out into the real world and you use the term decentralization, no one has any idea what the hell you're talking about. And so we can say and use this term as much as we want, but at the end of the day, it's going to be funneled through the players that we're working with today. It's going to be funneled through the banks, the fintechs, the asset managers, and funds. And so they just need a way to be able to provide better, faster, cheaper, higher yields and returns to their end users. And I think when we look at sort of the Americas, the Western world, that's really the focus today. I think decentralization plays a really important role in emerging markets where there is a lot of unbanked underbanked or non-banked folks who just don't have access to financial services. And I think that is really where the core of blockchain and decentralization really lies.
I agree with everything that was said, and I'm sometimes known as the DeFi party pooper. That it is like this is going to happen, but we need to be very, very clear of when and how. Like this is, without a question, the idea of like sitting in your underwear on a Sunday morning and drawing in your mortgage in via some DeFi pool sounds amazing, but that is attached with so many risks, and ultimately that is what the infrastructure layer needs to solve. So like this 3-5 year window of this is happening, because ultimately a change like this is across society, which means you can only move as fast as the slowest member. And that is ultimately where this is going. I completely agree with the fact that it will happen. It's just a matter of when and where.
Yeah, I totally agree. And I think one of the things that we haven't mentioned is really a deep understanding of the technical protocols at that DeFi level, where, look, that's not something to kind of short. At the end of the day, that knowledge is really critical in terms of adopting any kind of strategy. So you're faced with a number of challenges, whether it's regulatory, whether it's a lack of infrastructure, but also a lack of technical knowledge. That if we look at the folks in this room, we take for granted that we're immersed in this ecosystem 24/7. Many others aren't, and it's really about bridging that gap as well.
Great. And I think that's all the time we have for today. Thank you, everyone, for coming.